Putting clients first is no longer simply a marketing slogan. It's now the law.
Protecting the average consumer planning for retirement. Federal rules for financial advisors just got tougher. But could that make it harder to get investment advice? And now to Eddie ERISA on why financial advisors will soon need to be more upfront with their clients. Eddie.
Phil, starting next year, brokers or financial advisors who help people plan their retirement investments will be held to a much tougher standard. This comes after the U.S. Labor Department decided earlier this month that the so-called fiduciary rule should be beefed up. For many years, advisors were not legally required to give clients information about potentially cheaper products, but soon they will be. And Labor Secretary Thomas Perez says the change is a big win for average Americans.
I frankly refuse to believe that just because your savings are small means that you're not worthy of big protections. I refuse to believe that just because you may not be rich means that your retirement savings deserve poor advice.
But not everyone is entirely on board with the new regulations, and here tonight to give us their take on it are Adam Solano, an advisor with Lakeside Financial Group and president-elect of the National Association of Insurance and Financial Advisors, Illinois chapter. Terry Savage, personal finance author and columnist for the Huffington Post, and Nancy Coutu, co-founder of Money Managers Financial Group, which specializes in advising retirees and those clients close to retirement. Thank you all for being here tonight. Adam Solano, your organization was part of the advisory group, if we want to call it that was lobbying the Department of Labor. Tell us your thoughts on this change in the fiduciary rule.
Yeah, we worked very hard. We're a grassroots organization, and you know, at the heart of what we do is to not only protect our profession, but make sure things that are going on legislatively are in the best interest of the public. And for the last several years, roughly 1,000 of us would go to Washington, D.C. and visit with our legislatures and educate them, inform them, and update them on our perspectives and our views for the Department of Labor ruling.
But you're also with one of these organizations, you know, personal advice groups. So are you happy with the end result?
Yeah, I would say we're happy. If I can speak on behalf of the entire organization, we're not unhappy with the final ruling. I think there is a sigh of relief with some of the things that they listened. I mean, it's nice to see the process work and to see our representatives, not just in Congress, but also those that are in the Department of Labor and other departments listen.
So Terry Savage, are average investors the winners in this?
They may very well be, but I think we should get the semantics clarified a little bit. They didn't beef up the fiduciary rule. They extended it to people who call themselves financial advisors but were not required to follow the fiduciary standard. So let's define the fiduciary standard. It's very simple, though the legislation is 1,000 pages. It is, number one, that you put your client's interests ahead of your own, and number two, that you fully disclose any fees, commissions, trips to Hawaii, or anything else that you get because you sold the product. Now, investment advisors, certified financial planners, for example, registered investment advisors, have always been obligated to go by these fiduciary standards. That's nothing new for them. But stockbrokers, I have nothing against stockbrokers. That's, you know, how I started my career. But stockbrokers, people who sell insurance investment products like annuities, were not covered under this fiduciary standard. They were covered under something called suitability. And that meant that if you sold your client as a broker a mutual fund, and the client needed a good bond fund, and it was suitable for their needs, that was fine. But you didn't have to tell them that there was an 8% commission off the top, or that the same kind of a fund could be had through Fidelity or Vanguard for no upfront commission and lower fees. So now what you're getting is, it's interesting, the Justice Department, the Labor Department, by the way, took this over. The SEC didn't promulgate this rule. The Labor Department knows that right now all of us baby boomers are rolling out trillions of dollars from our 401k plans, where we did have all this information, to an investment world that wants to advise you and sell you stuff, and now you'll get advice that is in your best interest.
But that wasn't happening, Nancy. Is that true? Because as Terry has just pointed out, some were covered by the fiduciary group, others were not, and there was a lot of pushback, especially from Wall Street, wasn't there?
A lot of pushback because, again, as Terry mentioned, Wall Street has to function under suitability rules, suitability standard. You don't have to ask the client what their goals and time horizon is. You don't have to ask the client what their true risk tolerance is. You don't have to ask them what other things are already in their portfolio. You have an agenda. It's a retirement account. Oftentimes the house, if you will, gives them a list. This is what you will present. And it's about selling, if you will, one of those products. And you're dealing with people's life savings. This is not fun money. This is life savings. And when you're helping someone retire, there's a lot of work that should go into that planning. And this is going to be a new term for the financial advisors that only operate under suitability standards, because as a CFP and a registered investment advisor, I've had to operate under fiduciary rules for a very long period of time, and I take the time and I plan. And I think that's going to be new to the financial advisors on Wall Street, is that now they're going to have to be more of a planner. So it's wonderful for the public.
But do they have to disclose maybe either hidden fees or commissions or products that could be cheaper for their clients? Is that something that was not happening, Adam?
In some cases, sure, it wasn't happening. If you were acting in your client's best interest, even if you were abiding by a suitability standard, you were doing the due diligence. You were being forthcoming. You were disclosing any fees and expenses to a client.
Was it widespread in the industry, I guess is what I'm talking about, or was it just certain groups or certain businesses or certain individuals that didn't have the ethical standards that others had?
It certainly left room for those that didn't have the scruples to not do what's in their client's best interest. It certainly left that room.
So Terry, what's going to happen from here on out? Because as you mentioned, it's a 1,000-page, you called it legislation. Is this set into law? Will it go before Congress? Does it still have obstacles?
It's a rule. The Labor Department covers under the pension laws, ERISA, the employment and pension laws. The Labor Department has jurisdiction over retirement accounts, so that when you roll out of a 401k into an IRA, the Labor Department has jurisdiction. Now, they don't if you just happen to have saved up some money and put it in a fund or went to a broker. But because all brokerage firms now and insurance salespeople will be required to operate under the fiduciary standard, effectively, it will cover all this retail investing. So you will find, and you remember, regulation is good, but there's always a cost, and the person who pays is always the person who is being regulated. The firms will pass these costs on in the forms of, well, now you may not be selling commission products, but in order to deal with your favorite broker, you will have to be paying an annual fee, or there may be ongoing fees that over the long run could really subtract more from your account. Look, there are a lot of terrific brokers who were always acting in the client's best interest, and you can't legislate morality.
So what are you saying? Or what's the sentiment then? That the average investor is going to be paying more, that this isn't in their best interest?
It's always, I think, passed on to the average investor, and unfortunately the smaller investor. It's not going to be the larger one. So there might be a lot of smaller investors that wanted to be working with the financial advisor, and because of the extra rules and restrictions and cost involved in that advisor working with them, they might pass on that smaller account, in lieu of the bigger one that's going to make them a larger fee.
So smaller investors might end up paying more or losing the ability to have a wider range of advisors.
But
is that right?
What's coming out of the woodwork is going to be Robo advisors. And we already have them. They're competition for many investment firms. And other firms recognize that smaller accounts need not such specialized advice, but these Robo advisors are registered and they create products that are low cost. And you can help someone build up a retirement account in that way till they get to the point where they need more personalized, individualized advice.
Adam, what's your reaction to that?
Well, I work with single moms that are hairstylists, tool and die makers that don't have a lot of assets. And, I think the word commission gets a bad rap because it's a charged word. but it may be the least expensive route for some people, which is in the client's best interest. It may not always be a level ongoing fee. So the unintended consequences are, we really don't want, the single mom that doesn't have a lot of money getting pushed out of the market. And I'm not sure if they're even going to fit in a robo-advisor. I don't know how motivated they are to do that.
There are still some challenges ahead for these regulations, because there's going to be probably some legal challenges to this, and maybe even Congress will take this up. You yourself were telling me just before we began the show that you're heading back to Washington to lobby concerning these regulations. So what are the challenges that still face these new rules?
Well, for those of us that have a broker-dealer, because we now share that fiduciary responsibility with our broker-dealer, and so as they digest these pages, they're going to dictate a lot to us since they're sharing that liability with us, what we can and what we cannot do.
All right, Terry, we only have a few minutes left. So give us your advice of what you would tell investors at this point, nearing retirement or with their retirement accounts, what they should be looking for, what they should be asking.
First of all, you have to understand the difference between holistic financial planning, a certified financial planner, and investment advice. Then you need to understand that until next year at least, financial brokers and salespeople are not obligated to tell you their fees and commissions or tell you if there's another product. But you can still ask. You always have the right, and people don't speak up and ask, what's the commission in this?
That right has always
anything?
been there, isn't it?
Exactly, but individual investors so intimidated by money, and now suddenly having to roll out a lifetime worth of 401k savings and make a decision about a sum of money that could be $250,000 over their lifetime, now will have better guidance, and they should ask these questions right away. Check references, and I have a website for you, a new government website called smartcheck.gov, smartcheck.gov, where you can not only check out the FINRA broker check that has always existed, but investment advisors, commodity futures advisors, and insurance salespeople to check their track record, smartcheck.gov.
Nancy Coutu, do you want to add either a website or your own personal advice to this?
No, I just think that it's refreshing to me that this is actually happening. When you see over the years how a lot of people have been taken advantage of, I truly believe the majority of financial advisors in operation are already following maybe not the true form of fiduciary responsibility, but they are operating in the best interests of the clients. And I wouldn't want people to think that this is coming down because the majority aren't. Certainly there's those few bad guys, and unfortunately those few bad guys cost us a lot of money and a lot of inconvenience. But at the end of the day, it's always about trying to protect the public. So I think it's refreshing, and I'm for it.
Adam, as you head back to Washington soon, what's your advice to investors?
My advice to the young advisors, because the toughest thing I have as an advisor is to get them to save money and protect their families. And for those that have already spent the habit of saving for decades, start spending your money. Use that money.
All right, so spend a little, but save a little bit more. Adam Solano, Terry Savage, and Nancy Coutu, thanks so much.
Thank you.
Thank you.